Inspired Moneymaker. I am coming to you live from an undisclosed location. I'm here in Hawaii today to celebrate my mother-in-law's 94th birthday, which is actually today. So it's going to be a festive day, and I'm so glad that you are here with us. I want to pose this question to you. What if the biggest change to money is not Bitcoin? But what if it's the digital dollar? Less than a year ago, the United States enacted one of the most significant banking laws in decades. The Genius Act created the first comprehensive federal framework for payment stablecoins. And it could fundamentally reshape how money moves in the US and around the world. Could stablecoins make payments faster, cheaper, available 24 hours a day? And what does that mean for investors, businesses, and the future of banking? I have so many questions, and we're going to ask them. Welcome to Inspired Money. I'm Advisor Andy, and today we're going to separate the hype from reality. Before we begin, today's episode is brought to you by my investment firm, Runnymede Capital Management. Markets do not come with roadmaps, and investors today are navigating a lot of uncertainty, from geopolitical tensions and persistent inflation to interest rates and a new Fed chair. What does it mean for your portfolio? The question is not about whether uncertainty exists. It's whether your portfolio is prepared for it. If you'd like a second opinion, visit inspiredmoney.fm/review. Send me your top 5 holdings and one investing question or concern that you might have. And I'll personally record a complimentary video review with my thoughts. Again, that's inspiredmoney.fm/review. Hope to hear from you. Joining me today are leaders at the forefront of Treasury, digital payments, and digital assets. First, we have Craig Jeffery. He's founder and managing partner of Strategic Treasurer, one of the world's leading treasury consulting firms. For more than 3 decades, he's advised corporations, financial institutions, and government organizations on treasury management, payments, liquidity, and financial risk. We also have Larochelle. She's Director, America's Business Development at AAA, a globally licensed payment institution helping businesses send and receive payments using stablecoins and digital currencies. She works with organizations across the Americas to modernize cross-border payments while navigating the rapidly evolving world of digital finance. And rounding out our panel, we have Sir John Hargrave, published Bitcoin Market Journal, trusted by, I don't know how many, more than 100,000 crypto investors each month, and author of The Intelligent Crypto Investor. For years, he's helped investors separate signal from noise in the fast-changing world of digital assets and emerging financial technologies. So welcome to our panel. Today in Act 1, we're going to unpack the Genius Act, explain how stablecoins actually work, and explore why many believe we're witnessing one of the biggest changes to banking since the National Bank Act of 1863. In Act 2, we're going to examine what it all means for investors, banks, businesses, and corporate treasury, from portfolio allocation to enterprise adoption and compliance. And then stay with us for Act 3. I'm going to sit down with Lourdes Casanova of Cornell University, co-author of The Digital Currency Revolution. And we're going to explore how digital currencies are reshaping global finance and what comes next. So let's dive right in. Oh, Lourdes is here. Lourdes, are you going to participate in the panel?
Up to you.
I think she.
Okay, thank you.
It's up to me. Okay. Yeah, the more the merrier. We're going to have a party. Let's jump right into segment 1.
A monumental legislative shift occurred when the federal government enacted the Genius Act, establishing the first comprehensive federal framework for payment of stablecoins. The law created a pathway for federally regulated non-bank issuers, alongside banks, to issue payment stablecoins under defined regulatory standards. Crucially, it requires payment stablecoins to be backed one-to-one by highly liquid reserve assets, such as cash in short-term U.S. Treasuries, while establishing redemption rights and ongoing regulatory oversight. Together, these provisions are designed to strengthen confidence in regulated payment stablecoins and reduce liquidity and run risk compared with earlier, less regulated models.
What's the biggest practical change the Genius Act creates for a corporate treasurer that most people may overlook?
Yeah, I'll jump in if you just want us to jump in. Is that how you'd like to proceed?
Yeah, that question's for you, Craig.
Oh, okay, perfect. Yeah, I guess I think about that from a corporate treasurer perspective. Risk is a key area, and what is nice about the Genius Act is that it creates a full transparency to the assets that back the particular currency. It gives a framework, which is stability. The particular coin is pegged and can't be unpegged to the U.S. dollar. It provides the framework for using this other payment rail, if you will, effectively. That's quite a bit different from either crypto or some of the other stable coins that existed without the necessary regulatory framework that exists.
Lou, you work with businesses moving money across borders every day. Does the Genius Act make those conversations easier than they were compared to a year ago?
I would say definitely, especially here in the Americas, in the US. I think the most thing that the Genius Act did for businesses like us operating in the stablecoin payment space is to give regulatory clarity and provide more confidence to our clients in using this as a tool. So I would say from a compliance perspective, like it's helping in building our clients' confidence in this product.
John, you've covered crypto through every boom and bust. Does this law mark the end of the Wild West era for stablecoins?
Well, first of all, Andy, thank you for having me on today. And happy birthday to your mother-in-law. It's very exciting. I'm sorry that she has you trapped in the underground bunker there, but I hope it's a very happy birthday. Yeah, it is a sea change in crypto markets, because with stable coins now officially becoming a fully regulated instrument, we basically have an on and off ramp between traditional finance and digital finance or crypto. And that's very significant. We've always had it in the form of stable coins, but now that they have regulatory oversight, meaning we will be able to trust them in the same way we trust national banknotes, that is going to be a massive change. And I think for most people, most companies, most treasuries, you won't even notice that these are happening. What you will notice is that money moves faster and cheaper because, of course, that is the benefit to moving things digitally and to these new types of digital dollars. So it's really exciting. And the investment opportunity is really around the companies that are building the infrastructure to support these stable coins or these digital dollars. That's where I get really excited about the opportunities.
Lourdes, your book argues that we're entering a new era in the evolution of money. What are your thoughts here?
So first of all, is that for sure, as you were just saying, there is the possibility of transactions that are free and immediate. So what was happening till now, the friction was mainly in international transactions. Domestic transactions go very fast, but if I want to send money myself to my daughter who was traveling in Senegal, I had to go through a friend, and all this allows, of course, crypto technology, and in this case, stable coins, allow us for international transactions to work extremely efficiently and also for free. So this is a tremendous sea change. So how do we use the money? We use the money for domestic payments, for C2C. We use the money for C2B, B2B, domestically and internationally. I think for me, what changes with crypto, with crypto technology, and with digital currencies is the possibility of the frictionless international exchanges. The world is very global, and we continue all to be very global. And if you make a transaction, a payment to Brazil, Brazil has tremendous regulatory and very strict conditions. It's a nightmare. Or I said Brazil or other countries. So this, the technology allows it, whether digital currencies that actually use crypto technology or stable coins or any other technology. The technology is there, is allowed to do it. And of course, the major change is in international payments, both B2B, C2B, or government to government. Much easier to move the money.
Thank you. A sea change indeed. I don't know if anybody else is getting echo, but I'm getting a lot of echo on my side. So I'm going to hope to cure the technical difficulties on my side. Let's go into segment 2.
Legacy financial rails like standard ACH settlement often involve multiple intermediaries and settlement delays that can keep capital in transit for hours, or in some cases, 1 to 2 business days. Conversely, on-chain stablecoin settlement offers a fundamentally different approach to moving money. By utilizing secure smart contracts to move value directly from sender wallet to receiver, transactions can settle in near real time with rapid finality. Operating 24 hours a day, 365 days a year, this system has the potential to reduce transaction costs and improve the efficiency of domestic and cross-border commerce.
All right, I've cured my problems. I had YouTube open on another tab, so I had like crazy things going on in my ear. Luke, can you walk us through a real payment? Maybe a business in Brazil is paying a supplier in Singapore. How does that transaction, how is it different using stablecoins versus traditional banking?
I think there are 2 flows actually here that we can cover from the video that we just saw. Actually, the 24/7 instant settlement in stablecoin. This is actually a flow that is being less talked about. Like, I think right now when we talk about stablecoin, people are more thinking about this on-off ramp where you're kind of moving money from country A, local currency, to country B, local currency, right? This implies stablecoin in the middle, what we call the stablecoin sandwich a little bit, which we can go over it, which is actually your question. But the video actually addressed the movement of stablecoin itself as a form of payment. And this is effectively 24/7 and it's instant. So in the case of your example, someone in Brazil trying to pay an invoice in Singapore, they can simply pay that invoice in stablecoin. And in that case, it's really 24/7, no limitation, and instant settlement. So basically, they're paying their invoice to their supplier in Singapore in stablecoin. And more and more, it's being more widely adopted as more suppliers accepting stablecoin, especially in those big trade corridors. Now, let's address the other flow, which is actually someone in Brazil paying an invoice and trying to get his BRL into SGD in Singapore. So in this case, involving stablecoin will make the process significantly faster and significantly cheaper. However, depending on if an instant rel is available in the pair of currencies, it might or might not be instant. So take the example of BRL and SGD. The flow would be an on-ramper in Brazil will take this, importer's BRL and convert it into stablecoin. That process will be instant in Brazil because Brazil, they have PIX, which is an instant payment method. They can collect BRL in PIX instantaneously, and and convert it into stablecoin instantaneously. And then the second off-ramping leg, which will be converting stablecoin into SGD, they will need to have an off-ramper like AAA, for example. And again, depending on the corridor, on the rail of the currency, if it's possible to have instant or not. In Singapore, there is an instant rail. So that process can also be near instant, which make this flow of transferring BRL into SGD still almost instant with stablecoin in the middle. Now, there are certain currencies that is not instant, that is not like possible to have instant rails. So in those cases, it wouldn't be instant, but it will still be significantly faster than this person in Brazil trying to go to a bank and converting his BRL and trying to send money in Singapore, right? So these are the two flows that we're seeing.
Craig, how widely are Treasury teams using stablecoin?
It's pretty rare and infrequent. So these are very early days for using stablecoins. There's a lot more interest in figuring out what's going on. I'm just going to pull up some research we did to see where people thought we would be using stablecoins. If we look at stablecoin usage, this is from a fairly recent survey we did, digital currency with stablecoins, we look at 41% expect to use it within 3 years and only 7% within 1 year. So we're still in that range. So it's fairly limited use of stablecoins, partly because, as an individual, it's easy to transfer currency, have your own wallet, but that you have to use the infrastructure of treasury management systems or other platforms to move money that way. So it's very early days on the corporate world, and I think when the Genius Act becomes fully implemented and the rest of the regulations are laid out, that will provide more of the impetus to be able to move forward the regulations and then the structure to handle it, just like other payments that have been around for a while.
Yeah, early days. John, people hear programmable money. Can you give us a real world example that gets people excited?
Yeah, so one of the cool things about these digital dollars is that they are software. So just like any other piece of software, they can be programmed to follow certain rules and behavior. And today, one of the things that excites me the most is the possibility of AI and stablecoin. So if you can imagine AI agents, which are, of course, self-running applications that are going out and doing things on your behalf. You give it a set of instructions and the agent goes out and does it. Combined with the ability to make these digital payments via stablecoins, that is a huge wide open playing field. So in the example that we just heard about different payment types, imagine that you have a supplier or a company that has maybe 10 different suppliers. You could have agents going out and looking at each of those suppliers and even negotiating on the company's behalf for the best pricing from each one of those suppliers. And then when it finds one that it likes, it could automatically send payment via stablecoins. So because all of this is software, it can just be create sort of a seamless, autonomous, intelligent payments layer that is just constantly happening behind the scenes. And as consumers, we will have something similar to this, where if I want to go on a 3-day holiday to Canada, I can say, here's my budget, here's my criteria. I can load up a digital wallet and it will go out, find lodging and so forth. It can come back to me and say, here's the suggested itinerary. I say, great. And then it will just go seamlessly make the payments via stablecoins to all of these providers automatically. So no traditional payment rails at all. And that's where we're moving. In Lou's examples, that's right now kind of the leading edge where the early adopters are going. But within a few years, these kind of rapid stablecoin payments will be just the norm. It'll just be the way things are done. And all of our existing payment rails will be called legacy payment rails. So that's the importance of this shift that we're going through right now.
Lourdes, I know that you've written about how many emerging markets have skipped the older banking systems and they've kind of leapfrogged going straight into digital payments. Can you talk about that? Will developed countries be playing catch up to the emerging countries?
You're on mute.
Okay, so Lou mentioned PICs. So we are seeing in emerging markets, because here we are not mentioning credit cards. So credit cards stand to lose, or they will need to adjust to this new world. So as I was saying, in payments, let's say C2C. I want to pay my hairdresser, I want to pay my taxi, and here usually we use credit cards. What happened in Brazil, in India, and actually at the very beginning in China, where e-commerce, where Alibaba went full into e-commerce, was the beginning of the credit cards. So the credit cards were not developing at the same fast level. So guess what? Alibaba needed to find, so either customers would pay cash or had to develop something else, and they developed Alipay. Jumia Pay in Africa, Jumia, the first unicorn in Africa, e-commerce, they developed their own. In Latin America, the regional leader, Mercado Libre, developed Mercado Pago. But then you have this model of private companies, e-commerce mainly. Amazon has not in the US because we have credit cards, so no need. But Alipay, Jumia Pay in Africa, Mercado Libre, Mercado Pago in Latin America, they all developed their own mobile payment system. But then you have Brazil, a very interesting. So Brazil, what happened was because again, not enough credit card penetration. So then the Brazilian central bank developed what is called PICs. At first, banks were reluctant, but in Brazil, you have two state-owned banks, Banco do Brasil and Caixa Federal. Those had no choice but to adjust. And actually, seeing the initial success, all banks got in. So now everybody pays in Brazil with PICs. So then you have PICs in Brazil, alliance between central bank and the private and public banks. Second, in China or Africa or Latin America, e-commerce companies taking into the space. Also in Africa, you have a telco company, MTN, the famous South African, that has gone into the space. So C2C being taken over, as Lou mentioned before, by all these systems. And by the way, in India, UPI, developed by the government, again, being quite prevalent for payments. So you have this one. So then, as again Lou mentioned, how do you move between these systems? So you have now in New York more and more shops that say, we accept Alipay. Great. So if you are a Chinese tourist, you can pay with your Alipay account in New York or in other cities. You see it in Paris, in other cities. The question is, as Lou mentioned, how are we going to move between these systems? It's going to happen that here in this country, we have Venmo, Zelle, and actually more and more cash. So I got to pay my taxi the other day from home to the airport in Ithaca, and the guy said 28 cash or 35 by credit card. Or I go again to my hairdresser in Ithaca, and he says, that much cash, that much credit card. So this country, credit cards are prevalent. So we don't see much the problem of payments. Again, emerging markets going into mobile payments. The question is how we will move for the international payments, both, as I said, C2C, B2B. How are we going to move? And that's the question. So and it's a question of trust, another very important word. Do we trust the BRL? Because the BRL has moved between 6 to the dollar, 5 to the dollar right now. Even the dollar, devalued 15% in 2025, has recovered part of it. So the question is trust. How are we going to move? What are we going to convert the mobile payments in Brazil to make international payments to providers, etc.
Yeah, trust is a massive one because I hear widely in China that vendors don't want to accept paper money because they're worried that it might be fraudulent. They just want Alipay or through WeChat. So let's go on to segment 3.
The modern stablecoin explosion echoes the systemic chaos of the mid-19th century, when the United States was flooded with thousands of state-chartered banknotes trading at varying values. Congress addressed that fragmentation through the historic National Bank Act of 1863, establishing a federally regulated national banking system whose notes were backed by U.S. government bonds. Today, the Genius Act may represent a similar effort to bring greater consistency and federal oversight to privately issued payment stablecoins, with supporters arguing that it could reinforce the long-term role of the U.S. dollar in global commerce.
John, is the comparison to the National Bank Act fair, or are we stretching history a little too far?
No, it's perfect. As your video showed there, before the Civil War, there was no national paper currency. So all of the currency was issued by these individual state chartered banks, and they had widely varying values. So a $10 note from a bank in Ohio might be worth 10, it might be worth 8, might be worth nothing at all. They had guides. They were called banknote reporters, and they were made for merchants who were basically taking in these banknotes to know how much they were actually worth on any given day. So Lincoln and his Treasury Secretary, Salmon Chase, they had two problems. They had to finance the Civil War, and they had to fix this mess. So the National Bank Act of 1863, it created this new class of federally chartered national banks. And to get chartered, a bank had to buy U.S. government bonds, deposit them as collateral, and exchange, the bank could issue national bank notes. So this was a uniform currency. It was printed to federal standards, and you could be assured that a $1 was worth $1 anywhere in the country. So then Congress killed the competition by slapping a 10% tax on all the state-issued banknotes. So basically, there was no incentive for anyone to use them or print them anymore. So within a few years, all the state-issued banknotes went away, and the national banknote became the currency of the U.S. As it is today. So the parallel with what we're seeing today is very similar. It's the same playbook, where instead of state banknotes of wildly varying quality, we've had stable coins of wildly varying quality. Those of us who've been in this crypto space for some time have seen numerous stablecoin failures, like large stablecoins that have collapsed and not held their value. And under Genius, these stablecoin issuers will have to purchase treasuries to bank the banknotes, just like the early banks did. And it's the same regulatory institution overseeing this. It's the OCC, which is still around and now overseeing these permitted stablecoin issuers. So it is the same playbook 160 plus years later. And for that reason, I think it's going to work.
Craig, from a Treasury perspective, how valuable is standardization?
Well, trust matters, and standardization and safety are some of the key factors there. I guess if we look at, it was interesting when we were discussing the 1863 Act, and there certainly is some similarities about providing stability and standardization. And we're just in the next iteration of digitization. It's still a digital process. It's just there's some other elements that make it easier if you're using distributed ledger technology as opposed to multi-steps through a central ledger of the banking system or of a particular bank. The trust that a corporation would have in the unregulated environment is very minimal without the stability, without some of those, the safety measures of It gets pegged to the dollar, can't be unpegged. There's clarity to be able to see what's backing it. It's backed in extremely liquid assets, and it's not just reliant on trust of an environment or trust of the individual issuer of these coins. This is extremely important for corporations to use this, because speed is one aspect. There's certainly business cases and use cases that matter for corporations. Speed is one of multiple measures, I think, as we talked about. And so these use cases, whether it's cross-border or 24/7, like let's say the banks are closed and you need to get a certain amount of money to someone else, this helps the organizations be able to consider this more readily.
Craig, when it comes to liquidity, how much of a difference does settling today instead of tomorrow actually make?
It does and it doesn't. Let me explain that, because you can do an ACH that's same day. You can do wire transfers same day. They can be next day, and so there's a value date associated with some of the legacy systems. I mean, ACH has been around for over 50 years. You can set it up with a value for tomorrow, and it will leave your account, if you're the originator, tomorrow. It will fund the other person's account tomorrow. The risk and the holding and management of that is with the originating bank, the bank that you're initiating the transaction. But there is some inefficiency, and there's a lot of back and forth when you don't know where a payment is, especially if you're doing international payments. It used to take multiple days. People had to research, where's the payment? We sent it. We didn't get it. Where is it? Now the ability to see and have transparency facilitates not just the speed issue, but also the transparency helps with forecasting, visibility, knowing where things are. It de-risks the process. So those are pretty substantive items. As we more fully digitize, we get faster, we have better clarity, better visibility. That helps so many areas of managing liquidity. Not just is the settlement, do we not know what the settlement day is, but now we know it and we can see it more clearly and more readily.
Lourdes, does regulating stablecoins make the US dollar even stronger around the world?
Yes, of course. And I am of Spanish origin, so I wanted to go back for 1 minute to the National Banking Act of 1853. The US dollar was launched in 1792. Which country was the empire at that time? Still about to go, but still the empire at that time was Spain. So then the dollar was linked, who would have thought, to the Mexican peso and the Spanish silver dollar, what was called the piece of 8. Why? Because at that time, again, the power of a currency is linked to the power of the country. The steel power was the beginning of the British Empire, but still the power was Spain, and the currency to be trusted was the Spanish peso because it had silver on it. So that's why. And then, of course, it was a mess, as you are saying. At that time, during these 60 years, till the National Banking Act, the Spanish dollar and the Mexican peso, who would have thought, were accepted in the US as legal tender. A similar situation happened in Argentina in 2001. Argentina had the dollarized currency. In 2001, January, that was unsustainable. So the dollarization was stopped, and what was called the corralito. So the bank accounts were frozen. So what happened? The same that had happened in this country between 1857 and between 1792 and 1853. A chaos. You have to pay. So everybody was issuing currencies. I have a frame in my office with different currencies that were legal tender at that time in Argentina. You need money to pay. Anyway, so then the situation was, of course, organized by that very important National Banking Act of 1853. And yes, the stable coins linked to the dollar have been now regulated by the Genius Act. So similar, very good parallel. However, as I was saying, let's go back to trust. let's go back to, again, all the international trades. The most important commodity, the most important traded commodity is the oil, and the oil still is traded mainly in US dollars. Coffee, second most important commodity traded in the world, again, traded and fixed the price in US dollars. The question is that, yes, the stable coin has been regulated in dollars and make the dollar more attractive because make it easier for everybody in the world to buy treasuries, directly or indirectly. So yes, very important, and definitely the power of the dollar, and the dollar this year has been revaluing, has been gaining in value again, has recovered some of the losses with respect to the euro or the renminbi.
Thank you for the historical context. Lou, from your conversations with global merchants and what you see, where are you seeing the strongest demand outside the United States?
I would say the strongest demands are in dollar-starved markets. So in markets where, as Lourdes said, people value US dollars and people have a harder time to access to USD, stablecoin gives them an alternative to basically being able to access USD without being able to access to the US dollars, right? So liquidity in stablecoin is much, much higher in those dollar-starved market. We're talking about across Latin America. We're talking about across Africa. We're talking about across certain region in APAC as well. So these are where demands are the strongest. And also between the biggest trade corridors are where the demands are strongest. So we're talking about between LATAM and China, between Africa and China, and even between Europe and Latin America as well, I would say. People are leveraging stablecoin to make cross-border money transfer between their local currencies and euro.
Very interesting. So far, we covered what stablecoins are, why the Genius Act matters, why many believe we're witnessing one of the biggest changes to the financial system in generations. If stablecoins become mainstream, will they change the way that you invest, the way that businesses manage cash, and even the role banks play in the financial system? If you're just joining us, this is Inspired Money. I'm your host, Advisor Andy. Today, we're exploring one of the biggest developments in modern finance, the rise of regulated payment stablecoins, and what they could mean for investors, businesses, and the future of banking. So let's ask the practical questions. Do stablecoins belong in a conservative portfolio? How are banks responding to growing competition from digital payment networks? And what happens when corporate treasury accounting and compliance move onto blockchain infrastructure? Let's go right into segment one.
From a strict fiduciary perspective, investors can no longer look at stablecoins through the lens of speculative crypto trading. Instead, we must utilize a practical suitability framework to evaluate if digital currencies legitimately belong in a conservative portfolio. This allocation test critically balances immediate liquidity needs and cross-border transaction frictions against underlying counterparty risks. Furthermore, because the law explicitly bans stablecoin issuers from directly paying interest, investors must carefully weigh standard bank deposits against yield-bearing options offered through compliant third-party platforms.
Craig, from your perspective, should stablecoins be viewed as an investment or simply as a better way to move money?
I think they should be viewed as cash and a way to move money. I don't see them as an investment, especially with the framework not allowing interest payments on those. There's other digital assets that you can also transfer as a form of payment, or you can hold them and then quickly convert them to some type of stablecoin. So having some holdings for immediate, speedy transfers matters for insurance companies and other examples where a fast payment makes sense. I don't think of that as an investment for where you put your money, unless you're thinking of something else. But but certainly you would want to hold some for quick transfers to satisfy the speed. Some of the other digital assets, tokenized money market funds, digital T-bills. There's some other assets that would be useful because they're earning interest, and you could transfer them while they're earning interest and earning a yield. So that's kind of a mixed answer, I think.
John, what's your take when investors ask, should I own stablecoins? How do you answer the question?
Well, I refer them to my book, The Intelligent Crypto Investor, where I have a chapter on stablecoins. But I'll give you the TLDR, which is you invest in the infrastructure opportunities behind stablecoins. All right, you invest in the picks and shovels, the companies that are going to benefit by being the rails that these stablecoins are running on. And there's a lot of exciting opportunities in that space today. So these take the form of both publicly traded companies. So for example, Circle, the creator of US dollar coin, USDC, which is one of the top stable coins in the world. That's a publicly traded company that you can invest in. And they've been doing this for many, many years. So they have an incredible technology stack. They have a lot of regulatory compliance, which they've prioritized from the beginning. And that is a very, very big head start, as all of these other smaller players are all trying to spin up their own stable coins. It's going to be very hard to overtake them. The second category of investment opportunities would be crypto native companies. So these would be the blockchains or the other crypto protocols, projects, we call them companies, that you can invest in today that are going to most benefit from being able to run these stablecoin rails. So the simple, easy example would be Ethereum, which of course is one of the largest crypto networks upon which a lot of these stablecoin transactions run. Solana would be another one. And so the simple investing philosophy here is we identify those early leaders today, very similar to like looking at the early .com boom and finding, you know, the Googles and the Apples and the Amazons that were creating this massive infrastructure. We invest in them now, again, both publicly traded companies and crypto native companies, and we hold for the long term. That is the strategy in a nutshell.
Lou, how are businesses actually using stable coins today? Not in theory, but in practice.
Depending on the type of businesses, I would say one big category would be businesses looking to accept stablecoin as a payment method if they have clients internationally, especially in emerging markets, or if they have Web3 native clients. So we're seeing increasingly demand from ads platform or cloud platforms. They have big Web3 native clients, not even only in the emerging market, but even in the US and Europe. And those big clients are looking to pay with stablecoin or cryptocurrency. And this is a demand for those businesses to be able to accept stablecoin directly as a payment. And then you have trade businesses. Again, we're coming back to biggest trade corridors. They are looking to leverage stablecoin to make payments cheaper and faster. A very good example recently that I spoke with clients talking about import-export out of Chile to China, for example. So without this stablecoin on-off ramping infrastructure, a Chilean importer holding Chilean pesos, CLP, trying to pay an invoice, even in US dollars in China, if they go to a big bank in Chile, this bank will charge them sometimes over 10% to do the transfer, to do the FX and everything. When if they leverage the stablecoin infrastructure, this cost can be reduced significantly below 1% out of the entire flow. And then in addition to the fact it's going to make the payment faster. So that would be a second type of clients.
Lourdes, can stablecoins make it easier for investors around the world to invest in businesses that perhaps were previously difficult to access?
Yeah, you are very right. Even now, if I want to buy, again, going back to Brazil, Petrobras, very difficult for me to do it in separately. I have to do it through a fund that was through an ETF, so something like that. And also, I wanted to add something else to what Lou just said, is that strangely enough, as a unit of saving money, of course, the usage is mainly in this country, in Europe, but then as a transaction, cryptos, stable coins are more used in countries like Nigeria or Argentina. Why is that? Because you are a company, you want to repatriate your profits. And again, in Nigeria, the Naira has gone through a major, it's now recovering, but has gone through a major devaluation. So what do? You want to remove, you want to, as fast as possible, because yes, going back to the answer from Craig, if you are paying in dollars, if you settle the payment either today or in a week, who cares? The dollar is the most, or one of the most stable currencies in the world. But if you are paying in Nairas, and the payment in a week can be a difference of less, you can lose 50% or whatever. Crypto value has been very unstable as well, and that's why people also are moving to stable coins. But if you can repatriate your profits from Nigeria, you're an oil company, you want to repatriate as fast as possible. As fast as possible is very important, and you may gain a lot by settling today. So then you are using Bitcoin, stable coins, whatever you can do to repatriate your funds. Also, in times of instability, countries put restrictions in how much funds you can repatriate. So hence, the usage of crypto and stable coins, you will be surprised, is a lot in emerging markets, where their currencies are unstable.
Thank you. Let's go to segment 2.
Traditional banking cores are facing significant competitive pressure because much of their legacy infrastructure was never engineered to handle multi-decimal digital ledger systems. To respond to potential deposit substitution and increasing competition from non-bank fintechs, traditional institutions are deploying specialized middleware platforms called sidecar digital cores. These API-first middleware engines run seamlessly alongside legacy systems. This plug-and-play technology allows agile community banks to natively settle stablecoins in tokenized deposits in real time, preserving local bank liquidity.
Lourdes, if businesses begin holding more money in stablecoins instead of traditional bank accounts, what does that mean for local banks?
I would say, for me, the biggest threat that I see is for credit cards. Credit cards will need to reinvent themselves because mobile payments are expanding so fast in many emerging markets. However, banks are very powerful. Finance sector is a very important part of any economy, definitely for this country and definitely for any country. So banks may be able to negotiate who is going to hold these stable coins and where. Again, what we are seeing, for instance, in experiments about launching digital currencies, Nigeria, by the way, was the first major country to launch in full a digital currency, the Naira. No one knows, not even Nigerians are aware of it because of the question of trust. So, but then governments, what they do is agreements with the banks. So if the central bank issues in IRAs, who is going to hold these in IRAs? So then there are agreements with the local banks and the medium-sized banks to say, okay, I'll issue the currency to you and you keep them. And we see similar experiments. China has launched an experiment, a pilot, like many countries, on the use of renminbi. And what they have done, again, the same, agreements with the local banks and instead of paying directly the central bank, the local banks are doing so. So we, as you know, because of the geopolitical tensions, Europe is seriously considering, and because the worry that what happens if there is a restriction in the use of the credit cards, the Central European Bank is seriously considering the launch of the digital euro. I think we have to be very much looking into this experiment and see how it works with the banks. Again, if you pay directly with the euro, what is going to happen with the credit cards? The banks, again, that will depend on agreements between the central bank of Europe and the local bank. I don't think the local banks will allow that the retail banking moves to the central bank. Of course, not. So there are going to be agreements. And again, soon we'll see how it goes.
Lou, as businesses transition, I suspect they don't want to rip out their existing banking systems overnight. How do you see banks and payment providers bridging the gap between today's infrastructure and then tomorrow's digital payment rails?
Mute.
Oh, yeah, you're muted.
Sorry, I was muted. I think something that, as we speak more about stablecoin and the hype around stablecoin, it's important to remember that banks and banking rails are actually behind the money transfer still. Even when we talk about stablecoin, stablecoin is a tool to make cross-border money transfer faster and cheaper, yes, but the leg of collecting local currency on one side and the leg of delivering local currency on the other side between any countries, banks are involved. So banks are not like really being pushed out of this ecosystem. Banks are just adapting themselves to be able to work with this new infrastructure with stablecoin, right? Any use cases that we covered in terms of flow of funds between two countries, or even stablecoin as a payment method, eventually, as long as fiat currency exists and still is needed by global citizens of any countries, banks are involved. So we cannot even, banks are involved, not even involved, they're actually very crucial. AAA as one of the big player in building this stablecoin infrastructure and delivering, multi-currency off-ramping options. We have heavy partnerships with banks of all the countries that we are operating in. So let's really not forget that.
Can I jump in on that too? I
Yes,
think
absolutely.
I think Lou said a really, really important thing, that banks are involved in, ultimate settlement. Same thing with central banks in many cases. That's certainly true. I guess as we look at what banks make money on, one aspect is moving funds, is the payments business. And to the extent that the U.S., there's thousands of banks, over 5,000 banks, many of them aren't prepared for the new environment. And where are companies and individuals going to go? They're going to go to the ones that offer newer, better services. And so there is going to be additional shakeup, because not everyone's going to be ready, even though they may be connecting to the Fed directly and some other activities. So I think that's a significant risk for organizations over time. But banks certainly won't be disintermediated, in a sense of, hey, they all go away. But we have seen a decrease in the number of banks that exist that will continue to decline in the U.S. So, I'll leave it there.
So, Craig, do you think banks are more threatened, or are they more excited by stable coins, or does it depend?
I think some of them are more threatened, particularly if you're smaller, you're not involved in some consortium where you can offer those services to your commercial clients, your large corporate clients, your business banking. I think that's a risk. And so the challenge too that many organizations have, you talk about the core systems. Working as an individual, it's a lot easier to make payments, move your bank accounts than businesses. There's multiple layers of control that have to exist. And you want to take advantage of things like APIs, some of these other digital assets or payment stablecoins to support this increased digitization. Everything from virtual accounts to use of payment stablecoins, tokenized money market funds. You need ways to do that. You need ways to handle that. Banks play a part in a component of it. So this is the infrastructure is a big deal, and it's hard. So I guess yeah, I won't talk about investing because that's not an area I'm going to focus on. But there is a lot of change in the plumbing that has to go on, even in the two wire systems that exist. Right, everybody's converted to ISO 20022 to provide more support for things like compliance, regulatory, to stop money laundering, and terrorism. So there's more requirements around those things, not just in currency restricted countries, but across Western and Western Central America, Middle Eastern countries are adding different regulations continually to fight these things.
Hey Andy, I'll take the opposite side of this.
Okay.
I think the banks are screwed. I have been talking with these banks closely for the last 10 years about crypto topics, and I have been astonished at how little they understand and how little they want to understand about digital finance. And I understand this is not your legacy business, but if I sound angry about it, I am, because I think they've really done a disservice to their customers, to all of us, by underinvesting in this technology and just not showing any curiosity about it at all. Instead, it was all that crypto is a scam and it's all a fraud and it's a bunch of hucksters. Well, guess what? Crypto is now the future of your business. Like, this is the future of the financial system. And so they're trying right now to play catch up. Many of them are launching their own stable coins. Like, technology is not generally their strong suit. Do you know how long it took them to allow me to change my password on an ATM? It was literally 25 years from the time they really rolled out ATMs to the time I finally got the ability to change my password on an ATM. Technology is not their strong suit, and suddenly they're going to spin it up. Meanwhile, I think we're going to have a lot of very credible alternatives to traditional banks. I think we're going to have digital wallet providers, for example. We're going to have fintechs. We're going to have other types of entities that serve many of the same functions as a traditional bank. And for a consumer, especially a young consumer that's doing all their banking and all their finance on their mobile phone, who cares? They don't care. They don't need a branch. Maybe they need a bank for a mortgage eventually. But there's so many reasons you just don't need banks anymore, and they are so far behind the curve. So I think we're coming into a banking crisis. I think some banks will survive this coming wave of digital finance, but I think a lot won't.
Craig, any response to John's comments?
Yeah, no, I like that. I like especially how you came out really hard on it. They're screwed, and then you kind of backed it up a little bit, backed up a bit on the. You'll need some banks. I mean, you certainly need banks to provide credit, and they are settling transactions, and they're a trusted party. But there is going to be the shakeout. I guess I would be interested, John, to see if you see this continued shrink in terms of the number of banks. There are some banks that are spending more on that. They have to bridge multiple worlds, just like when you move, like if a country didn't have telephone service and then all of a sudden it's cell phones, well, you don't have all this legacy infrastructure you got to deal with and work around. And so there are some advantages to that. I guess if I'm just laying a few things out there too, we look and see Ripple buying G Treasury. I'm focused on the corporate space. A treasury management system. It's the ERP of treasury groups, that type of thing. And so they acquired G Treasury, and so they're leveraging that into that space. And just like you see Circle getting into the corporate universe. So there's fintechs, but also collaboration on the banking side. So there is an ongoing shrinkage of number of banks that exist, but I don't think they're screwed. We've seen so many of those things where it's a real big problem, or an anticipated problem. But there are going to be winners, losers, and those that just barely hold on.
It'll be interesting to see through this transition who wins, the banks, fintechs, or maybe companies that don't even exist yet Let's bring it home and go to segment 3.
Adopting stablecoins for corporate enterprise applications introduces significant operational and regulatory challenges for bookkeeping departments. Corporate accountants must navigate evolving compliance standards, establishing strict internal controls to handle real-time valuation timing, complex revenue recognition rules, and rapid fiat currency conversions. To successfully survive institutional audits, financial compliance officers must deploy appropriate digital identity tools while documenting every on-chain transaction ledger discrepancy to align seamlessly with traditional cash equivalent reporting standards.
Craig, if you're a CFO watching today, what's one thing you should start preparing for right now?
I think if you're a CFO watching today, one thing that I would say here, maybe I'm not answering your question directly. One thing I would say is the ability to handle not only the movement of money, the recording, the custody, the tracking, all of those things have to be solved, and they aren't going to be solved by focusing on just speed or just payment stablecoins or digital assets. The ability to have wallets is the next generation, as opposed to custody accounts or demand deposit accounts. How those things are tracked and how those are managed is the next step. And so those things have to be integrated into the process. I think that is getting back to your question about what should the CFO look at and say, what is changing and what infrastructure do I need to support this ongoing shift and increased digitalization of payments, of managing and holding activity. That's probably the number one concern they have to address.
Lourdes, how do regulators strike the balance between preventing financial crime and encouraging innovation?
So, two things. One, we are in uncharted territory. We don't know yet what is going to happen. So there are no expert regulators. So the space, obviously, money is central to any economy. Fiat currencies are central to any economy. And again, we are into this tremendous disruptive situation. So we need this to be regulated. If I go back to China, to Alipay became the biggest player in consumer finance in China, till the point that the banks pressured the government to have Jack Ma spin off the company where they had stored all the know your customer information, and then this information had to be available to absolutely every bank in the system and every financial institution. So we are in uncharted territory. If you look at, for instance, you are in the informal economy in Nigeria, 50%, 60% of the population. How do you give small loans to this person at a reasonable price? So again, today you have a lot of information from this person, the telco company has, how much he calls, how much he pays, how he pays through one of the fintechs. So this information is available, and guess what? Now you can provide a $1,000 loan, a small loan to this company through that information. So definitely all this needs to be regulated in a way that has started with the Genius Act, excellent, but we need more regulation in this space that, again, the whole space of Bitcoin. Still, let's remember that I believe there is 1/3 of money circulating in stable coins with respect, although this space is changing all the time, but I remember that data point in December when we published the book is that there is 1/3 of money circulating in stable coins and triple in Bitcoin because it has been longer. So these spaces need to be regulated.
Lou, from your perspective at AAA, what are you seeing? Can a business getting it right actually accelerate their business?
What type of business are we referring to here?
I don't know. I'm just thinking that a lot of businesses often view compliance as a roadblock. How do you make compliance an advantage?
I think compliance is actually a huge advantage rather than a roadblock, because people are still all businesses, especially non-Web3 native businesses, are still a little bit skeptical about cryptocurrency, although they view stablecoin a little bit different, even though it's more or less the same thing. Having a very strong regulatory framework and compliance framework can inspire more confidence from those clients. I think is a positive rather than a negative. And I think having a very strong licensing framework can actually help new client acquisition, I would say, rather than hurting it. But then after that, operationally, of course, more compliance, more regulatory framework equals a little bit more operational process, I would say. But for example, right, in Europe right now, everybody needs to, as of 2 weeks ago, migrating to Mica, from their current VASP. And if you have your license from a very strong jurisdiction, like AAA, we have our PI license from France. It's, I would say, the most strict regulator in Europe. We were able to get our MICA very, very, not necessarily easily, but it was not, it was more straightforward, whereas a lot of companies are being licensed in jurisdictions that are weaker, like Lithuania, for example. They're having a very hard time getting their MICA because MICA are being issued by central banks, right? So I think compliance is extremely important. And once you no longer fit in within the compliance framework that is required, then clients will have more doubt and they will walk away.
Things are changing so quickly. John, looking ahead 5 years, what excites you most about the next chapter of digital finance?
Back in 2011, the famous venture capitalist Mark Andreessen, he said, software is eating the world. Software is eating the world, by which he meant we were moving from this world of non-digital to digital. So paper mail was giving way to email, and physical media, books and CDs and papers were moving to digital and streaming. And today we can look at that and say, well, obviously that's what happened. So today I have a corollary, which is crypto is eating the financial system. Crypto is eating the financial system, by which we mean there's a mind shift that's needed. Today, most people think of crypto as this weird little fringe thing over on the side. And what Genius will do is create new kind of rails between this world of digital finance and traditional finance. I'd argue that is the wrong way to look at it. Flip it and say instead, crypto is going to eat the entire financial system. And what we're doing right now is creating these on and off ramps that are going to make it easier and faster for money to move back and forth. We all know that money will move wherever it can move the fastest. We've all heard these stories of like trading firms that will pay millions of dollars in rent to put their servers just a few milliseconds closer to the New York Stock Exchange, right? So time is money. And what is faster than digital 24/7 instant money transfer? That's what stablecoins make possible. So this is very simple and logical and obvious to me that this is where everything is going. And again, the opportunity today is to invest in the companies that are going to provide these rails or these key infrastructure components, the picks and shovels of this new money movement to stablecoins. So we're going to take these old dollars and we're going to throw them away because they're all going digital, Andy.
Thank you for the illustration. It's very powerful. Well, thank you, Lourdes, Craig, Lou, John. This has been a fantastic discussion. Thank you for sharing your expertise and helping us to separate hype from reality. Before we part ways with our panelists, just a really quick, go around. I want to ask everybody to finish the sentence. The future of money is blank. And we'll start with Lourdes.
The future of money is digital and mobile and instant.
Craig?
Increase, well, it's one word you said or a phrase?
That's up to you. I leave that, whatever you like.
I'll repeat it, increasingly digital.
Increasingly digital. Lou?
I think the future of money is global.
And John?
The future of money is inspired. What I did there?
I see what you did there. Wonderful.
Yeah.
Well, I encourage everyone watching today to learn more about our guests. We'll include links to Strategic Treasurer, to AAA, to Bitcoin Market Journal, and to Cornell in the show notes at inspiredmoney.fm/blog. I encourage you to continue learning from all of our inspired guests. Now, we spent the last hour talking about how stablecoins are changing payments and banking. But what about the question, what does this mean for the future of global finance? And we're going to be spending the next 20 to 30 minutes with Lourdes Casanova, talking about her book that she co-authored, The Digital Currency. We're going to bid farewell to John, Lou, and Craig. Thank you again to the three of you for participating today and accepting my invitation. Let's talk about the future of money. If we can have Lourdes stick around. I don't know if she has a hard stop at the top of the half hour or not, but let's talk about the future of money. Will digital currencies strengthen the US dollar or reshape the global financial system in ways that we're only just beginning to understand? This is Act 3 of Inspired Money. I'm your host, Advisor Andy. To help us look beyond today's headlines, I'm so excited to have Lourdes Casanova, director of the, is it Canizares Center?
Yes.
For Emerging Markets at Cornell University's Johnson Graduate School of Management. She co-authored The Digital Currency Revolution. And in this conversation, we're going to explore how digital currencies are transforming global finance, whether today's stablecoin movement echoes historic turning points in banking, which we have covered some today, and how businesses and governments are balancing innovation, privacy, regulation, and trust in this increasingly digital world. So Lourdes, we're going to go into segment 1.
Why do traditional banking institutions look at the rise of private digital ledgers with growing attention? For generations, global corporate finance relied entirely on traditional clearing networks that trapped institutional capital for days on end. But recent academic analysis suggests we have reached a historic turning point where private sector innovation is outpacing public infrastructure. Many experts argue that legacy depository models could face increasing deposit substitution as corporate treasurers shift billions into fully reserved on-chain stablecoins. It is a massive structural realignment. Forward-thinking regional players are rapidly launching sidecar digital cores to remain competitive. The question for investors and businesses is whether moving beyond traditional banking protocols toward an instant settlement engine that never sleeps will fundamentally reshape global finance.
Lourdes, in your book, you argue that we're at a historic turning point in the evolution of money. What convinced you that this isn't just another fintech trend, but something fundamentally different?
So we started working on this 5 years ago because a lot of the activities happening in emerging markets. And then for the last year, we worked with the late Dr. Mark Mobius, a legendary investor in emerging markets, John Ninia, who was working with him, and Sharbari Pandit, who was at McKinsey. And we started in full discussing what was happening. Dr. Mark Mobius and John Ninia were traveling the world. So while we were having our weekly discussions, they were reporting from Jamaica, Bermudas, India, China, or Brazil, where mobile payments have become so prevalent. So as I said, there are a number of things. One is C2C, customer to customer. We are having a dinner with friends. Each one has to pay his own part. So how to pay that? So we do with Venmo. Or again, more and more, what is happening, I have to transfer. Again, my daughter is at the university. She needs urgently $200. How do I send it? In this country, I have Venmo, but guess what? She doesn't like Venmo. She's using Zelle, so I have to go to my bank and use Zelle. While, again, so the success of WeChat Pay, Alipay in China, again, a private initiative. These are in a country that is very much having a very important government role in the whole economy. This was led by private companies, WeChat Pay and Alipay, with all the consequences. You have, again, other e-commerce companies, Jumia in Africa or Mercado Libre in Latin America, who launched their own payments. And as they launch the payments, again, you are in uncharted territory. What happens? So if we look now, right now in Brazil, part of the consumer finance is taken over by Pix. Why? Because you buy a pair of shoes that, by the way, the shoes in Brazil are very expensive. So you have a party, you want to buy these beautiful and expensive shoes. So you decide to pay the shoes. That's very common in Brazil in 3-4 times. If you handle this payment through the shop, the interest rates will be very high. However, the digital currencies, stablecoins, bitcoins, all the lower the cost of this transaction. So then Pix can do what is called Pix parcerado in 3 times, in 4 times, at a much cheaper price. So what happens? Yes, the banks were reluctant because they were losing commissions. They were losing this consumer finance segment that is very profitable for banks. But then at the same time, in Brazil, or even in this country, there are still citizens that receive their salary in a check. You go and cash the check and you continue paying by cash whatever your daily needs. If you have a Pix in this country, what will happen is that this person will be paid by Pix. It may be paid by Pix, and then will pay with this Pix. So you increase the pie, the size of the pie. People, again, in emerging markets that are in the informal economy that can range from 30% to 50, 60, 80% that are outside, that no one does business with them, can be part of the system, can be something that is so expensive for banks. Know your customer, very expensive. You have to spend so much money in having the right profile about the customer and knowing how much you can give in the mortgage, or again, in a small loan, or for an SME. You don't give loans to small and medium-sized companies. So then who is going to capture this business when the informal economy in this country or in other countries, who is going to capture the small loans, mortgages, and payments? So who is going to capture? So it's going to be captured by the mobile payment that is being used, or is going to capture by, again, the banks that become part of the system, and they realize that even if in the first phase, the commissions that are able to charge go much down, then the service is much cheaper for them and better to be part of the system. That's what we have seen in many countries all over the world. And again, if I go to the example, I have some money in Venmo. I keep money in Venmo. Of course, that money gives me 0 interest. So what about if Venmo incentivizes the fact that, to give an example of a private company, a private fintech, what about if Venmo decides to incentivize those of us who keep money in the system with some interest? So yes, we are in uncharted territory. There are many opportunities for different businesses, And then, of course, those who will not adjust, as we discussed before, stand to lose, for sure. But then, as we discussed in the previous segment, banks still and will still be at the heart of the business and at the heart of the big transactions between companies. And for me, we don't know 10 years from now, but in the next years, banks will be central to the financial system of the world.
Lourdes, one of your more provocative ideas is that corporate treasury could change dramatically. If you're a CFO 5 years from now, how different might managing cash look like compared to today?
Yeah. So again, one thing is that your services, so the cost of anything, transactions, treasury, will be less because, again, the technology of blockchain allows the ledgers, allows instant transactions, immediate, and your treasury is much more fluid and much faster. You don't need to call 10 times your provider again, we gave the example in Mexico, and say, have you received my payment? Or your Mexican provider, or in Guatemala, or in India, you don't need to call him or her 1,000 times to say, did you receive my payment? That will be instant, and you will see it immediately. So then, number one, much faster. So I would say you will have less work, but of course your opportunities will be tremendous, and we are moving into digitalizing your treasury. That will be much faster, where you can invest. Again, we discussed this before. As of now, I want to, as a business or as an individual, as a citizen, I want to, how do I buy Reliance shares, to give you an example? So how do I manage my treasury? I want to buy, I am operating in Indonesia, and I want to buy, I know the Indonesian market very well. So guess what? As a way to manage my treasury, I want to invest in the stock market of Indonesia. You have to do it through your subsidiary. You cannot do it through your central from US. Very, very difficult. So all these things will be global. We discussed that before. The world will become more global, more instant, more rapid, more transparent. So much better.
Lourdes, do you have another 15 minutes to spare? You've been so generous with your time.
Okay, maybe 10 minutes.
10 minutes. Okay, yeah. Let's roll segment 2.
Yeah.
We often see casual investors mistake the entire digital asset ecosystem for a speculative wildcat territory. Yet the passage of the federal stablecoin framework marks an important milestone in the regulation of payment stablecoins. Fiduciary analysts note this transition echoes the historic National Bank Act of 1863, which helped reduce the chaos of thousands of unique private banknotes trading at wildly fluctuating values. By mandating a strict one-to-one backing with cash in short-term treasuries under federal trust safety nets, the modern framework transforms tokens into highly regulated payment instruments. This isn't a retail trend. It is a highly supervised, specialized architecture designed to preserve financial soft power on a global scale.
Lourdes, I didn't get to ask you earlier. Do you think this comparison to the National Bank Act of 1863, is that a fair historical comparison, or is it very different today?
Yeah, it's a great comparison for sure. However, as we discussed in the previous segment, what is happening is that we believe that the financial system will become even more global. And then this FDIC regulates the local transactions. What about the global ones? So the Bank of International Settlements tried to regulate, but again, with the geopolitical tensions that we have, they had this project of Enbridge, so how to move funds from, and definitely multinationals need to do it all the time, repatriate profits, send the funds for investments, and move money to different places to what is called tax efficiency, etc., etc. So how will this be regulated? So how do you, and again, we discussed this particular example with two currencies. One, the Singaporean currency, very stable. Another one, very unstable, the Brazilian real, BRL. This currency has moved in the last 10 years from the value of 1.5 to the dollar, then 6 point something, to now around 5. So how do you do that? Again, very complex, and that is not yet regulated. China is making efforts to regulate that space of how you move currency, how do you do digital transactions. Do you still go through a US dollar-based stable coin between buying oil from Saudi Arabia or from Venezuela, for instance, again, another country with a currency that is definitely very, very unstable. So how do you buy? Till now, you would buy oil in dollars. But now, moving to digital currencies, how do you buy the oil? In which currency? In which digital currency? Do we buy in as the transactions are immediate? Do you settle the value of this in your local currency or in the? So that has to be regulated, and it's not clear. Hopefully, the Bank of International Settlements will move into that, but that needs to be regulated. So FDIC is for this country. Genius Act is for this country, for the dollar stable coins. But are we going to have stable coins in many other currencies? So probably yes. Again, Europe, a very important currency, the euro. Are they going to move fast to a digital euro? Will they launch a pilot in October, November this year? So remains to be seen. Very complex issues with tremendous consequences. So we don't know that yet. We need more regulation globally, for sure.
Yeah, it sounds like stablecoins in the near term could strengthen the US dollar, but longer term, it could actually challenge the dollar's dominance.
That's a very important question. As I said before, when the US dollar was launched in 1792, was pegged, strangely enough, to the Spanish currency because Spain was the empire at that time. So we have many currencies right now in the world that are very old. For instance, the sterling pound was launched in 1775. The Russian ruble in the 13th century. Currencies, the power of a currency is linked to the power of the country. Of course, this is the most important economy, the most important country in the world. The US dollar will not disappear, will continue to be very, very strong. When you want to settle big transactions, you need to have stability, you need to have trust, very important. And yes, in the US dollar, we trust and will continue to trust. These things don't disappear overnight. But it's clear that we have many other experiments with launching. China is pushing a lot. Again, Europe may accelerate one project that was on and off. But of course, European payments depend on the SWIFT and depend also for the international transactions and of course the US dollar, and depend also a lot on the payment providers that are all, so the American Express, Visa, MasterCard. And so they are worried that Europe is worried that because of political tensions, this is being questioned. So that's why they are now accelerating the launch of the euro. It remains to be seen. For now, I believe the stable coins definitely reinforce the US dollar. and that I see it for the next 5-10 years. Again, uncharted territory. We don't know what will happen. We don't know how many currencies will be digitalized and how fast.
Thank you. We're going to roll the last segment and then spend just a minute or two.
Moving corporate money instantly for fractions of a penny sounds like an absolute Treasury triumph, but the operational nightmare is that transparent public chains leave a visible, permanent data trail for your direct competitors to analyze. Ledger patterns can easily expose your exact supplier pricing, capital transfers, and payroll shifts. How do we balance institutional confidentiality with strict federal compliance? Emerging privacy technologies, including zero-knowledge proofs and permissioned access models, may offer one path forward. By utilizing specialized, read-only viewing keys, an enterprise can selectively grant access to authorized compliance officers on demand. The broader challenge is finding the right balance between commercial secrecy, regulatory transparency, and operational efficiency as digital payments continue to evolve.
Lourdes, businesses want transparency for regulators, but not for their competitors. How do you see that balance evolving?
That is, of course, an unstable balance. But again, privacy and confidentiality are at the heart of these initiatives. And for instance, when India wants to launch its own digital currency, and privacy is a very important point that is being taken into account. However, let me also be devil's advocate, and of course, many payments at the consumer level and also small companies level are going through the big payment systems. Again, let's go back to the credit cards. Our bank also knows my life and the life of the small companies for sure. So I would, of course, the digital payments increase this lack of transparency, but at the same time, already now, there are many institutions, many companies that know what we do with the money. If sometimes I don't even dare to visit some websites, because the next month or so, if I visit where I buy my clothes, for instance, then this company will every time send me some advertisements. So again, privacy, and of course AI again. So sometimes I'm worried. Of course, we are all worried of how much information we add in AI. How much, again, the use of AI tools. The use of AI tools is again encouraged in companies, and at the same time, there are financial institutions that don't allow any use of AI because of this worry of sharing too much and having this, of course, becoming this part of the knowledge of the AI tool that you are working with. So this is a problem that AI is only increasing as well. So definitely a difficult balance: regulation, transparency, privacy for us as a consumers, for small and medium-sized companies, and of course, for big companies.
Lourdes, thank you. This has been a fascinating conversation. Thank you for being so generous with your time and sharing all your thoughtful comments. I'm going to leave a link to the digital currency revolution in our show notes, as well as to the Cornell website. Anything that you want to share with everyone?
Yeah, so I think let's remember that it's not a coincidence that many of these mobile payments have started in emerging markets. So the tremendous power for financial inclusion. Again, I did in this country, many people receive the funds with a check. They have no bank account still in this country because a bank account is too expensive. So now we have the opportunity to offer financial services that are cheaper for the provider, and of course, allow the people at the bottom of the pyramid to access financial services. So let's remember the tremendous power for financial inclusion, for increasing the pie, both for the financial providers, but most importantly, for those who have been left behind in this country and all over the world where poverty prevails still.
Thank you, Lourdes. So powerful, the financial inclusion, and such a positive message for the world. Thank you, Inspired Moneymaker, for joining us and for helping us to really work together on how to make more, how to give more, how to live more. Before we wrap up, I just want to share a quick favorite Inspired Money moment from today's discussion. I think for me, the biggest story is not cryptocurrency. From our discussion, the word infrastructure came up repeatedly. Throughout history, the way money moves has continued to evolve. And whether stablecoins ultimately become commonplace or not, understanding the technology, the regulation, and the global forces shaping tomorrow's financial system helps us to better become investors today and to be better decision makers today. One thing that I want you to do this week is to take a closer look at how money actually moves through your own financial life, whether it's sending a payment, receiving a paycheck, moving money between accounts, or paying a business overseas. Ask yourself, could this work faster? Could it be cheaper? Could it be more efficient? Because the future of money is not just about new technology. It's about solving real world problems. So again, thank you to all of our panelists. Thank you to Lourdes. Congratulations to her on the digital currency revolution. As I said, I'll leave links in the show notes, which you can find at inspiredmoney.fm/blog. Inspired Moneymakers, if you enjoyed today's episode, please like this video, subscribe to Inspired Money on our YouTube channel, and share the conversation with someone who wants to learn more about the future of money. Let's stay connected. You can find me at LinkedIn. Just search for Advisor Andy. If you're listening to the show, you can message me with your biggest takeaway. And a special thank you to the Inspired Money team, Bradley, John Eaglefeather, and Chad Lawrence for helping to bring conversations like this to life. This is Inspired Money. Until next time, do something that scares you, because that's where the magic happens. Thank you, everyone.